the relatively unpopular large company. If we assume that it is the habit of the market to overvalue common stocks, which have been showing excellent growth or are glamorous for some other reason, it is logical to expect that it will undervalue, relatively at least, companies that are out of favor because of unsatisfactory developments of a temporary nature. This may be set down as a fundamental law of the stock market, and it suggests an investment approach that should prove both conservative and promising. The key requirement here is that the enterprising investor concentrate on the larger companies that are going through a period of unpopularity. While small companies may also be undervalued for similar reasons, and in many cases may later increase their earnings and share price, they entail the risk of a definitive loss of profitability and also of protracted neglect by the market in spite of better earnings. The large companies thus have a double advantage over the others. First, they have the resources in capital and brain power to carry them through adversity and back to a satisfactory earnings base. Second, the market is likely to respond with reasonable speed to any improvement shown. A remarkable demonstration of the soundness of this thesis is found in studies of the price behavior of the unpopular issues in the Dow Jones Industrial Average. In these, it was assumed that an investment was made each year in either the 6 or the 10 issues in the DJIA which were selling at the lowest multipliers of their current or previous year's earnings. These could be called the cheapest stocks in the list, and their cheapness was evidently the reflection of relative unpopularity with investors or traders. It was assumed further that these purchases were sold out at the end of holding periods ranging from 1 to 5 years. The results of these investments were then compared with the results shown in either the DJIA as a whole or in the highest multiplier, i.e., the most popular group. The detailed material we have available covers the results of annual purchases assumed in each of the past 53 years, Pot 5. In the early period 1917-1933, this approach proved unprofitable. But since 1933, the method has shown highly successful results.